Namaste investors. We recently invited Mr. Ganesh Nagarsekar, who is very active on Twitter and has a company called Bharat Bet Research, which is an investment advisory platform. He has more than 10 years of investing experience and has worked in companies like JP Morgan and Goldman Sachs. In this particular webinar, he discussed about health insurance sector and why Star Health remains a very interesting stock to keep track of. I hope you will like this session. Thank you.
Hello everyone, this is Ankit Kanodia from SmartSync Services. SmartSync Investment Advisory Services is a SEBI registered investment advisory firm based out of Ahmedabad. Mission Smile is an educational initiative started by us in Jan 2021, and over the last 40 months or so, we have had the endeavor to learn not only from the research of our team at SmartSync Services, but to call our peers, our friends, our guests from the industry so that we can have a much more holistic learning about different industries, different sectors, different businesses. And also we call veterans from the industry and do their podcast. To know more about our Mission Smile services and everything, I'll just share the link on the chat box in some time. But let me introduce our guest for today, Mr. Ganesh Nagarsekar. Welcome, Ganesh, for the 16th Mission Smile guest webinar. I've been knowing Ganesh for the last 2 years or so, and I've been following his work, his deep research on Twitter, and I'm a big fan of how he writes some really meaningful Twitter threads on different companies and industries. In fact, even for the health insurance sector webinar which we are doing today, I think Ganesh wrote a very good detailed Twitter thread. In some time, I'll share that threads link as well for the benefit of everyone. So Ganesh is a SEBI registered research analyst, and he helps investors, specifically HNIs who have 20 lakh plus funds to invest in the market, with his deep research on Indian equities. Ganesh has done engineering from BITS Pilani and MBA from IIM Calcutta. After that, he has worked with some really good funds like Goldman Sachs and others. And over the last 2-3 years, he has been into this profession of helping investors learn about market and advising HNIs on their equity portfolio. Ganesh is also a CFA charter holder. And I am very happy that in a very short period of time, Ganesh accepted this request from my side and prepared the deck in no time. I think he prepared it in 2-3 days itself. And I have seen the deck. It is very well made, very well researched. So I would request all of you to keep yourself ready and be ready to take notes, because it's going to be a little heavy session going by the content which I have seen from Ganesh. So with this, Ganesh, all over to you. Please go on. I'll be there. I'm switching off my video, but I'll be there all the time.
Perfect. Thanks a lot, Ankit. And thanks a lot for this opportunity to present. So as you've heard, we've been connected for a while now. And when we were discussing this, health insurance is one space which is relatively undercovered in the broader media and broader research as well. And since we've done a good amount of research on this, I thought it might be helpful for the SmartSync users as well to get a good overview of the health insurance sector. So the way we've designed this presentation is we'll be starting off with an in-depth understanding of the health insurance sector. We'll be tackling the India opportunity, understanding a few terms which will help you kind of differentiate between the good and weaker companies in the health insurance space, as well as look at the various client groups and the competitive environment in the space. And post that, we'll be looking at a deep dive into Star Health Insurance and understanding how that business kind of stands out amongst the rest, and look at a brief thesis for the business as such, right? Before we kind of start, a regulatory disclaimer. So I am a SEBI registered research analyst. Star Health Insurance, which is a company that we'll be covering in this presentation, I'm personally invested in the business. Around 100 plus of my clients and their families are also invested in the business, right? So with that being said, we've tried to keep the presentation and the sectoral overview as neutral as possible and as data backed as possible. But it is my responsibility to give you this disclaimer about my kind of investments in the businesses that we're discussing, right? So take everything that we're discussing with a pinch of salt. The intent behind this session is primarily educational to help you understand the sector and the firms better. And none of what I'll be discussing in this session will be a recommendation, right? I think Ankit Bhai has already discussed a brief overview about myself. So did my engineering from BITS, did my MBA from IIM Calcutta, worked with JP Morgan, worked with Goldman Sachs, was a top-rated analyst at both. Started off my startup around 4 years back. So running this for the better part of 4 years now. Primarily focused on providing equity research, India equity research for SHNI type of clients, right? So clients with 20 lakhs plus of equity surplus is the clients that we focus on, right? So just a brief overview about me. With that, we'll get started with the meat of the material, which is the health insurance sector deep dive, right? Now, before entering any particular sector, because we are looking at health insurance from an India perspective, right? We're looking at Indian health insurance companies. It will help to understand the one, how health insurance in India has done till date. And secondly, what is the opportunity size that we're talking about, right? In terms of over the next, say, 5-10 years or so, what kind of growth can we see in this sector? And whether that sector itself is important, is attractive, right? And why this is important is because if the underlying sector itself has good tailwinds, right? So if the underlying sector itself is poised to grow at, say, 15 to 17% odd, better performing companies within that sector who are well motivated, focused on the right consumer segments, these businesses will kind of give you better returns there. And as a result of which, you'll get a good growth in your underlying business over, say, a long period of time, right? Which is something that we are looking for in the investments that we make. So with that, let's get started with the India opportunity for health insurance in India. As you would know, out-of-pocket spend for health insurance is extremely high in India, right? It has improved significantly over the last few years, now below 50% odd. But still, if you compare out-of-pocket spends, even compared to forget developed market countries, right? Even if you compare out-of-pocket spends to developing countries like, say, China or Indonesia, we are substantially ahead of our peers there, right? So a long way to go. A bulk of our spend on healthcare still comes out of pocket, right? And why this is important is because, especially for say the lower middle class and the lower class segments, hospitalization or healthcare related spends is one of the major drivers of people falling back into poverty, right? Because healthcare spends for most people tend to be a sizable amount. Even if a person is hospitalized once at a reasonable hospital, the bill there will be sizable, and most people aren't able to afford that, right? And if you have to spend that amount out of pocket versus, say, an insurer paying that, it will dent your net worth materially if you're on the lower side of the net worth spectrum. And that is a recurring problem in India, right? So the way the government has been tackling it right now is the government has been coming out with health insurance schemes of their own, but we'll tackle the problems with government insurance later in the day, right? What is important, what is the key takeaway from this slide as such, is if you look at out-of-pocket spends for India compared to almost even all of our domestic emerging market counterparts, we are still significantly worse off, right? So there is a very strong need of greater insurance in India so that out-of-pocket spends can be reduced as such, right? The second important factor that we look at is healthcare inflation, right? And healthcare inflation, as you can see, India kind of has been shooting up across compared to even emerging market counterparts like, say, the China or Indonesia, and substantially ahead of developed market countries like US or UK, right? Earlier, around, say, 21, 22 or so, some believe that the spike in health insurance costs could be a bit COVID linked and stuff like that, because the stress on the broader healthcare system was larger. But what we've seen even as we emerged out of COVID is health insurance inflation continues to be sizable as such, right? And this again is a key strain on the pockets of the retail consumers as they as and when they are hospitalized, and more so for say the retired folks, right? So people who are dependent on a pension or a limited income, as they need healthcare more, this kind of pace of healthcare inflation puts them at a lot of stress, increasing the requirement for a health insurance as such, right? Uh, Now coming to the key slide here, which is the health insurance penetration, right? So again, if you kind of look at the trajectory, we've been consistently improving. But what is important to note here is the bulk of our insurance is still coming from the government, right? So there are three major consumer sets, broad consumer baskets as such, when you come to insurance, right? First is retail. Retail is people like you and me going to either an agent or going to an insurer directly and buying a health insurance policy for ourselves. That is by far the most lucrative part of the real estate segment, but it is a very small part of the in terms of number of consumers, right? So if you look at the number of people in India who take insurance via the retail route, that is still around 5.2 crores odd, right? We have the number later in the slide. But that number is still around 5.2 crores odd. So less than 4% of people in India take retail insurance. A good chunk comes via group businesses. Group is basically if you're working for a particular company, what that company will do is go to either an insurance broker or go to the insurance company directly and negotiate an insurance for the larger group as such, right? So for all of its employees, some companies also have insurance for the employees' parents as well, right? Again, here there is a challenge on the premiums and the coverage that you have, because obviously when you're kind of negotiating at such a rate, you kind of tend to get the premiums down. But in terms of coverage, there are a lot of restrictions and restrictions that come in terms of both the network hospitals as well as the amount of coverage that you have. And the last part of it is the government business. The government, by sheer number, insures the most number of people in India. But this is not very useful insurance, right? So just to give you the scale of things, for a person at the bottom of the pyramid, it is extremely useful for them. But the average premium for a government business is around 730 rupees or so, right? So we'll be covering all of this later in the deck. But the average insurance for a government business is extremely, extremely low, right? So average annual premium for the government business is around 720 rupees. Just to give you context, for an average retail insurance, this number will be around 6,500, right? So massive difference between the premiums for the two. And as a result, the coverage also varies, right? So the amount of cover that you have will vary. The amount of network hospitals who accept your insurance will vary. And as a result of which, even though optically the numbers look good, the key number we need to focus on is the retail insurance penetration. And that number is still sub 4% in India, right? So a very long way to go for more people to kind of get good, steady insurance in the country, right? And then we come to insurance density. Insurance density, simply put, is the dollar value of insurance premiums paid per capita, right? So if you look at this chart, obviously we've been consistently improving. So this chart is from the IRDA report. We've been kind of consistently improving through time. But even today, broad total general health insurance, right? So general health insurance includes stuff like motor, marine, fire, everything. General health insurance as a total per capita is still below $20. And health insurance density is still sub $10, right? So we are, as a broader country, still paying very, very low premiums per capita. A bulk of the reason is that retail insurance penetration is low, and retail insurance is the primary sector where you have higher premiums as such. So as retail insurance penetration improves, the insurance density in the country will improve. And as the insurance density in the country improves, what happens is that your out-of-pocket spends come down, right? Because there is a wider range of hospitals who will accept your insurance. There'll be higher cover for you and a lot of things that come with it, right? So that in summation is the India opportunity. Now, what happens is that in a lot of cases, optically, it will look like it's a very, very attractive opportunity, but the sector for long periods of time does nothing, right? In health insurance, that is not the case. If you will see over the last, say, 6 years or so, we've compounded at a very, very healthy CAGR, right? We've compounded at, say, 19.5% odd, showing the need of kind of good quality health insurance in the country. And over the next few years as well, we've got a good trajectory here, right? So around 15 to 17% is what the broader sector is poised to grow over the next 5 years or so. What is important to know here is that the growth rate here is of the sector, right? So individual firms who are kind of better poised in sectors which are faster growing will potentially go faster than this as well. But at a sector level as well, right? Because when we're investing in a sector, it's important that the broader sector is also kind of growing well. So on a sector level as well, we've grown premium substantially well over the last 5 to 6 years and poised to grow at a good rate in the future as well, right? So that's a brief understanding of the sector, which we thought is helpful kind of going in, right? What we also cover now is a short introduction to the health insurance industry in India. We'll not kind of, so it'll just be a brief history of how the health insurance in the country has developed. The intent behind this is to just give you context that a large part of the growth that we've seen, right, a large part of the innovations and the new entries and the new kind of policies that have come in have largely been developed over the last 2 decades, right? So that's the primary intent here, to kind of give you an understanding of one, how the sector has innovated and kind of moved forward. And second, how the regulator has been largely conducive to kind of letting new, better players come in, letting better policies come in, and doing all this while being considerate of the policyholder in the country, right? So IRDA, which is the apex authority for insurance in the country, was established in 1999. The IRDA Act kind of outlines the objectives of the regulator in the country, which is primarily to protect the interests of the holders and to kind of regulate and manage the growth in the industry as such, right? Now, why it is important to understand the importance of this particular regulator is that the broad regulatory intent decides a lot of things in the industry, right? It will decide one, how fast players are allowed to bring in innovative products. It will decide, say, how fast the broader sector is allowed to grow. It will decide how stringent the regulator is against actors who kind of having some sort of malfeasance and stuff like that, right? So having a good regulator in place, especially in a very tightly regulated sector, right? So insurance, for obvious reasons, because your health is on the line, because money is on the line, is a very, very tightly regulated sector. So having a good conducive regulator is very, very critical, right? And IRDA, to its credit, has been extremely supportive in not only letting good, better players in, but coming out with good, better products, coming out with a lot of innovation, right? So over the last, say, 20 odd years or so, everything from group health insurance product introduction to TPA introduction, who basically help intermediate between insurance companies and hospitals. So when hospitals do not have one-to-one networks, these can kind of intermediate between hospitals and health insurance companies, to introduction to standalone health insurance companies, right? So Star Health Insurance, which we'll be covering later in the deck, is a standalone health insurance company. These businesses were introduced as late as 2007 or so, right? So a bulk of the innovations and the new products that have come in have all come in over the last 2 decades or so. And the regulator, to its credit, has been extremely supportive of growth, while keeping consideration that it has to be a prudent regulator, not kind of allowing excesses on either side, but at the same time, not doing anything to kind of stunt growth and innovation as well, right? And the last part of it is basically the recent history. So post 2020 odd or so, as you would all know, we had a major pandemic across the world, which hit India as well. What this did was it kind of impacted the broader country, broader productivity as well. But the health insurance industry, it hit substantially harder, right? because as you can understand, as people kind of fall ill more and make claims more, the stress on the health insurance industry goes up, right? So health insurance business makes money when the client puts in premiums, and they have to pay out claims to the client as and when the client needs health insurance, right? And during periods like these, during periods of the pandemic, the requirement of claims from the client kind of go up significantly. If we'll be covering what claims ratio is later in the deck. So broadly, what claims ratio is the amount of claims that you have to give out divided by the the amount of premium that you are taking in every year, right? Uh, in regular years for retail health insurance, this number is around 70% or so. As you can understand, during COVID years, this number spiked significantly. For group health insurance, it's typically closer to 100. Again, for group health insurance during COVID years, you saw a very, very sharp spike, right? Now, post-COVID, right, over the last 2 years, these numbers have now come back in line with long-term averages. So the retail side is again around 75, 76% or so. Group side is again around 97, 98% or so. But what happens that broader sentiments around the sector, because you've seen 2 years where you had a very sharp impact on the books, tend to be a bit muted, right? So important to know this context going in, uh, because broadly companies have recovered from it. Their ratios and operations have improved. So you might be operating in an environment where the businesses now are in a much better condition, but investors at the back of their mind might have certain inhibitions or slight uh, inhibitions when looking at a particular sector, right? So this for you is an opportunity. If the broader sector has recovered and is doing well, but customers are still kind of, investors are still kind of holding back. For people like you and me, that's an opportunity to go in and invest in good quality businesses, right? So that was just a brief overview of the history. Again, the intent there was not to kind of bore you with what has happened over the last 20 years or so, but just to give you context about the regulator in terms of the progressive nature of the regulator and the growth supportive nature of the regulator, which is again very, very important and a very key thing to monitor, especially when you're looking at very, very regulated sectors like the health insurance space, right? Uh, Now, before we dive deeper into the presentation, I thought it would help to kind of clarify certain terms. Uh, these terms are not very complex per se, but what happens is that if you do not know any of the basic definitions going in, understanding the concepts, understanding the ratios that we'll be discussing later, can become slightly tricky, right? So what we're doing is we'll take the next 8 to 9 slides or so to just understand what each of these ratios mean and how we should be thinking about that, right? So we'll not understand not only the definition of that ratio, but whether if a particular ratio is high or low, what implication does that have on the operations of the business and how we should kind of look at it, right? Uh, Now, the health insurance business or insurance in general, right, is a very special business in that the customer will effectively pay you first, and the service that the customer will take will come at a later date, and that again is contingent, right? So, if say you are a 30-year-old individual going to take a health insurance policy, you'll be paying out a premium in year one, you'll be paying out a premium in year two, and God willing, if nothing happens to you, you might pay your premiums for the next 10 years or so, and your claim might be in say year when you're 45 years old, 50 years old, whatever, right? So this is a unique industry in which the client pays you the premium first, and the claim comes at a later date, right? Which is basically whenever the client is hospitalized or has to undergo say a surgery, the client at that point will make a claim, right? What this does is it gives you a unique advantage as a business of having excess money, right? So clients are coming to you, paying you money upfront, and they will effectively redeem the money at a later date as and when they have. Just a second, I think we have a few messages in chat. Okay, I'll just look at the questions later. I think Ankit has shared a few links and we have a few questions as well. I'll just wrap this session and wrap the this segment, and then we'll look at the questions as well, right? So broadly, what we get because of this is something called float, right? So you have a surplus pool of capital that you can then deploy in assets in, say, relatively safe fixed income instruments, but generate a good, say, 7 to 8% incremental return on that, right? And this is very, very important for most businesses because, as you've seen, uh, a bulk of businesses in India do not generate an underwriting profit on the insurance, right? So if you look at the core underwriting business, that will be barely breaking even, and most businesses in India, most health insurance businesses in India actually run an underwriting loss. So on the core underwriting business of the health insurance business, they're running a loss where they can kind of make up for it is on the incremental income that you get on your float, right? So we'll be looking at float in a lot more detail later. But this is just to kind of set the premise of the advantage of the health insurance model as such. Again, so I think most people, because you'll have health insurance yourself, will be fairly familiar with the concept. But the concept here is basically of pooling risk, right? So a lot of people will come in and pool their risk together. The health insurance company gauging the risk of each individual client will try to price the insurance for them accordingly. So someone, say, who smokes or someone who has obesity might have slightly higher premiums, stuff like that. You'll pool the premiums for a large group of people. And what happens is that net, the claims that are made out every year, your hope is will be substantially lower than the premiums that you're collecting. And that's how you kind of run the business, right? Now we come to two important terms that you will kind of come across quite a lot when you're looking at insurance companies. The first is gross written premiums, and the second is net written premiums, right? So basically, when you as a insurance company, now assume, say, Star Health Insurance, right? So Star Health Insurance is going out to retail clients and onboarding these retail clients with them. These clients will pay a premium to Star Health every year. What Star Health will now do is it will have an estimation of risk, right? So there will be a few tail events that might come in, which kind of create extraordinary risk for the business, right? So say something like a pandemic where a lot of people fall ill together is a tail risk, right? So in most cases, that will not happen. But as and when it does happen, it can create substantial risk for you, right? Or you might also want to kind of just broadly spread the risk to a reinsurer. So what you do is there's a national reinsurer, right? So GIC is the reinsurer for India. So you will go to the reinsurer, you will pay a part of your premium that you're collecting from the people to the reinsurer. And the reinsurer, what he will say is, in exchange for this premium, he will cover your tail risk or surplus risk, right? So depending on the kind of contract that you'll have with the reinsurer will basically say, I'm taking some premium for you, but if your claims kind of exceed a particular limit, or if your claims for a particular segment increase too much, those claims effectively I will cover it. You will not have to cover those. So basically, your gross premium that you're collecting from the customer minus the premium that you're paying out to the reinsurer is the net premium that you're collecting, right? Now, reinsurance is a very important concept to understand. So we've just covered one slide where we are covering this as such. Broadly, so you don't need to understand this to invest in a insurance company as such, but we just thought it is good to kind of cover it because you will have a good idea about the types of reinsurance that are there, right? So you've got broadly 2-3 types of major reinsurance contracts. The first is quota share, right? So quota share is basically a simple pro rata agreement, which is basically, you'll say this is a pool of a pool of people I want to insure. This is the premium that they're paying me. I'll pay a pro rata part of this, right? So I'll pay 10%, 15% of this to the reinsurer. And whatever claims are made by this segment, 15% of this or 10% of this, depending on the pro rata agreement, will be paid by the reinsurer instead of you, right? This is just a way to take off excess risk from your books and put it on the reinsurer's books. You also have surplus share reinsurance, right? Surplus share is basically, you will say this is another group B of clients that I have. For them, up to a certain amount of claims, let's say up to say 100 crores of claims, all of those claims I will bear on my books. But any claim above 100 crores will effectively be borne by the reinsurer, right? What this ensures is this kind of takes care of your tail risk, right? So if you have say one-off events like say like the COVID pandemic and stuff like that, having your surplus share insurance will help, because effectively you will be paying out to a certain limit, and any claims post that are effectively covered by the reinsurer, right? And then you have excess of loss reinsurance. This is basically to help cover the reinsurer as well. So what the reinsurer will say is, I will take care of excess claims beyond a certain limit, but that will be capped as well, right? So that what that does is, up to a certain limit, it protects the reinsurer as well, right? So these are just broadly 2-3 types of reinsurance, potential reinsurance contracts that you have. The reinsurance is one mandated by the regulator as well. So the regulatory minimum now is 4% odd. So you'll have a mandatory reinsurance, which the regulator says you have to do. On top of that, depending on your own assessment of the risk that your business has, you can take on additional risk, additional reinsurance as well, right? And obviously, depending on the type of client set that you have, you will choose between the kind of risks that you have. So if you are kind of underwriting a relatively good set of clients, where your assumption of the claims there is on the lower side, you might want to go on say a quota share and stuff like that. So depending on your assumption of your risk or your understanding of the risk, you can take incremental reinsurance beyond the regulatory minimum. And most insurance companies in the country take a substantially higher reinsurance, right? So as you can see, a part of the total premiums that you collect will go towards your reinsurance. And again, as and when you have claims, a part of your claims will also be covered by the reinsurer, right? So that kind of covers tail risk and excess risks from a standalone insurer perspective, right? Right. Just give me one second. So next we come to claims ratio. Now, claims ratio is an extremely important ratio for you to understand, because this is effectively one of the most important drivers of underwriting quality, right? So whenever you're judging an insurance company, the core factor that you actually want to judge is the ability to underwrite, right? And what an ability to underwrite is you should have a good enough understanding of the customer to understand the risk that the customer poses and price your product accordingly, right? So obviously an insurance company will want to kind of price its product as attractively as possible, but there will be a lot of constraints to your pricing as well, right? There'll be a regulatory constraint, there'll be a competitive constraint as well. A bulk of the constraint in the Indian context is primarily competitive, that you have a lot of players effectively vying for the same set of customers. So you have to make your offering competitive enough for it to appeal to the client. At the same time, not keep the price so low that you're actually losing money on the business, right? So claims ratio is nothing but the net claims that you have to pay out to the clients divided by the net premium that you earn. Net premium is your premium less your the reinsurance premiums that you're paying. Net claims is again the total claims net of the claims covered by the reinsurer, right? This number, obviously, the lower it is, the better. For most good, well-run companies, you will find the claims ratio somewhere in, say, the 60 to 65% odd range, right? So good, well-run standalone health insurers will see claims ratios sub 65% odd or so. Obviously, when you are looking at companies, say, on the public side, right? So public health insurers in India primarily underwrite government insurance and stuff like that, where the mandate is completely different, right? So a private health insurer, a standalone health insurer, will have focus profit at the core of his business as such. With the government, obviously, the intent is a lot different. The intent is social welfare. The intent is getting insurance at as attractive a price to as many people as you can. As a result of which, the claims ratios for businesses which are government heavy tend to be substantially higher, right? They tend to be in some cases even north of 100% or so. And as you can understand, if you are running a business, you will have your own operating expenses as well. You'll have commissions you need to pay out as well. So if your claims ratio itself is above 100, there is no way you're making an underwriting profit, right? So to run a good, steady business, you need ideally a claims ratio of sub 65% or so, right? Then we come to expense ratio. Expense ratio again covers two major parts. One is to run your business, you will need operating expenses. You'll need a facility where you have to kind of pay rent. You will have employees whom you have to pay. You will have various other costs where you're kind of doing your diligence, your people are working. You'll have all of those operating expenses. Plus, you'll also have commissions that you're paying out, right? So depending on the channel that you're going through, you could be going through individual kind of agents, you could be going through brokers, you could be going directly to the client. But depending on the network, the route that you choose, the channel that you choose, you'll have to pay a good amount of commissions as well, right? So the combination of the addition of your operating expense and your commissions is your total operating expenses. And this operating expense divided by the net premium that you're making is the expense ratio, right? Expense ratio, again, the lower the better. A good, well-run business typically can maintain its expense ratio, say sub 30% or so, depending on the amount of inefficiency in the business. This kind of, in some cases, tends to go on the higher side as well, right? So net, these are two. So your expense ratio and your claims ratio will be ratios we'll be tracking very, very closely as we go through the exercise, right? Because as you understand, having these two under control are very, very important for you as a business to generate an underwriting profit in the insurance space, right? Then we come to combined ratio. Combined ratio is nothing but the sum of your claims ratio and your expense ratio, right? So if your claims ratio is say 65%, your expense ratio is 35%, your combined ratio will be 95% or so, right? The intent here should be to kind of keep your combined ratio sub 100%, because what that effectively means is from your core underwriting business as well, you are generating a profit, right? If your combined ratio is north of 100%, from your core insurance underwriting business, you're effectively losing money every time you underwrite, right? And as we will kind of look at various sorts of clients as we move through the exercise, combined ratios, especially for companies on the focus on the government side of things, tend to be extremely high, right? So you want a good, well-run, disciplined business, which is kind of consistently generating underlying insurance profits, right? So the combined ratio again is very important to track. But if you're tracking claims and expense, you have a top of mind ballpark of the combined ratio as well. But we've just covered it because a lot of insurance players will give you the combined ratio as well. So important for you to know what a combined ratio actually stands for, right? And then we cover the last part of it, which is basically the yield that you generate on the float. So as we discussed before, insurance is one business where you have your premiums coming in on day one and your claims happening at a later date, which gives you surplus pool of money to invest in the market. This pool is obviously invested in relatively safer instruments like your government securities, T-bills, AAA NCDs, REITs, InvITs, stuff like that, which give you a steady yield year on year. What happens is that, especially for Indian insurance companies, the float that you have, right, this amount that you can deploy in the market keeps going up every year, right? Because you will continuously underwrite more and more people every year. because you are in an actually growing business. The premiums people pay will obviously keep growing. One, as they grow older. Second, there'll be a certain amount of healthcare inflation as well. So the broader float that you have, and plus insurance by its very nature is a very, very sticky business, right? So we'll look at Star later in the deck. But a good, well-run insurance business in India has north of 90% retention, right? So you have a combination of these three factors. You have more people coming under the insurance ambit. You have people paying more per policy every year, and you have a very, very high retention, north of 90-95% or so. The combination of these three factors ensure that your float in a way keeps growing every year. What that allows you is that you need not deploy that float in extremely kind of short-term instruments or so. You have a reasonable ability to kind of deploy in relatively longer, higher duration investments as well. Your duration call will obviously be a factor of the interest rate environment. So obviously, as you understand, as interest rates come down faster, being positioned on the higher duration side of things is attractive. If you believe interest rates are poised to kind of go up from where you are currently standing, being poised on the lower end of the duration curve will kind of help you, right? So that is obviously a call you can take. And these days, most of these instruments are relatively liquid as well. But what it allows you is it allows you to have a growing pool of money that you put in every year in relatively long-term instruments that will give you a good enough yield on the business, right? So that is a brief overview of the terms there, which is kind of important to understand the broader sector as such. I think we had a question in the chat. I'll just try to take that. And then we'll proceed. Just give me 1 minute. Just give me 1 second. I'll take the questions one by one. All right. Right. So the first question is primarily around broader, say, misuse of the health insurance space and kind of that having a negative repercussion on premiums and kind of affecting people who are kind of using health policy in the right way, sir. There are reasonable amount of checks and balances in place. The insurers, especially on, so basically we'll be looking at the three sets of insurers later in the deck. So you've got three major categories of insurers in the country. You've got your public insurers who are primarily focused on underwriting government insurance. You've got your private insurers who do things across the spectrum, right? So you've got the likes of, say, your ICICI Lombard, who will do motor, marine, fire, as well as health. And then you have a standalone health insurers, like, say, your Star, your Care, Niva Bupa, who are focused on standalone health insurance, right? So especially on the private side and the standalone side, the diligence process is quite sharp. So even if you do your scuttlebutt with hospitals, you will see that they will have people in close contact with hospitals. They'll have a lot of network hospitals on their books. So Star, for example, has close to 14,000 odd health insurance, 14,000 odd hospitals in their network. And with them, they have negotiated prices for each sort of thing ahead of time, which gives them kind of good comfort there as well. Plus, it also allows them to kind of do significant diligence on kind of policies to kind of ensure that misuse of policies and stuff like that doesn't happen, right? So especially on, say, the private side and the standalone health insurance side, that is not much of a risk. With the public side, it could happen, but again, that is not a space that we're looking at, because as we will cover later in the deck, that by itself is not a very attractive segment, right? So the core segments that we are focused on kind of manage this risk reasonably well, right? So Star Health again takes it from GIC, the General Insurance Corporation of India, which is controlled by the government of India. All insurance companies in the country will be taking your reinsurance from the same country. So that's a regulatory mandate as such, right? Want to understand claim settlement ratio? Taking a hypothetical form. Right. So the claim settlement, the claims ratio. Okay, you're looking for the claim settlement ratio or the. Right. So the claim settlement ratio is basically the number of policies, the number of. So it doesn't kind of distinguish between, say, your honest or dishonest and stuff like that. So the claim settlement ratio is basically, if I'm, say, having 100 policies come in who are demanding a premium from me, I'm paying, say, 86 of them. My claim settlement ratio will be 86, right? So Star for a long time had a broader image in the market, that their claim settlement was on the lower side of things. This was kind of driven by a variety of factors, the quality of underwriting going in, stuff like that. They've improved on that significantly, right? So they had a large part of the group book. They've brought the group book down. Broader underwriting practices have improved. As a result of which, they can now improve their claim settlement, right? So Star Health's claim settlement, say 2-3 years back, was around 80% odd or so. In FY24, Star Health's claim settlement is at 86%, right? So this again is an important factor that a lot of people track, and Star, to its credit, has been working on improving that as such, right? Is there any regulation that benefits a standalone versus no? So there's no regulatory benefit for a standalone health insurer as such. What we will look at when we compare the key players here is that there are, as we've understood, right? So the retail health insurance segment is one of the key, most lucrative parts of the broader market. And standalone health insurers are well poised to kind of gain share from the retail market because of some of the moats that they've built, right? So we'll look at the number of individual agents that these guys have on board, and standalone health insurers here are kind of miles ahead of competition. And especially on the retail side of things, people need a certain amount of handholding for your health insurance product, because especially when you're dealing with the claims part of things, you want someone coming in who will help you with the claims process and stuff like that, right? So having a good individual agent network is very, very critical. Standalone health insurers have been able to build that out relatively well. Having a good network of your network hospitals is important, because in your network hospitals, you can effectively do your cashless treatments. Plus for the health insurer as well, it's beneficial because they've kind of got pre-negotiated lower rates from the hospitals in their network as such, right? So we will look at the moats that the standalone insurers have built versus the rest, which kind of help them kind of get not only a better claims ratio and a better combined ratio, but are able to kind of grow substantially better as well, right? Duration will kind of vary. Typically, for most people, the duration is around 4 to 5x or so, right? So the McLaurin's duration for most of the standalone players will be 4 to 5 years or so, right? But again, this is a call that you can take depending on, so the insurer will take depending on their view of the rate environment as such. So if they're looking at, say, a reduction in rates over the next few years or so, they could kind of take the duration up a notch, right? So they'll do it subject to certain constraints, but you have a good amount of flexibility there, right? So just give me 1 sec. I'll have a flip of water. Right. So next we look at the key customer groups that you deal with in insurance. So we've looked at it briefly when we are looking at the India opportunity as such. But this is one part that we need to understand very well, because what we effectively need to gauge from this is which part of this is the most lucrative segment, and as a result of which part should insurance companies focus on, right? Now, when I say which part should insurance companies focus on, I'm donning a pure capitalistic hat, right? So my focus is profit maximization, and I want to operate in the segment where profits is the highest, where profits are the highest, right? That is not to say the government shouldn't operate in a particular segment or public insurers shouldn't underwrite certain insurance, right? They have a different mandate. Their mandate is social security, better coverage for the bottom of pyramid, which is a very, very noble intent to have. My objective when I'm looking at a company is a purely capitalistic objective, right? I want to maximize the profits that I can generate. And when I'm looking at attractiveness of the segment, I'm operating from purely that lens, right? So just a disclaimer kind of going in, nothing against public underwriters, nothing against government underwriting. But our intent going in this exercise is a bit different, right? So government again is a volume driver, underwrites a large number of people, but it is a low value insurance, right? The premium, as we will look at the numbers ahead, is extremely low, and it is not commercially viable. So if you look at the combined ratios of anyone doing government underwriting, they'll be north of 100%. Which is basically on your core underwriting business, you're running a loss, right? They'll then have to take additional risk on their flow, kind of invest in non-premium kind of assets, and they kind of have implications of that as well, right? So government by itself is a volume driver focused on social objectives instead of profit objectives. Then you have group. Group is an interesting segment. Because there are certain segments within group insurance which are extremely attractive, right? So group as a whole is basically larger industrial groups, right? So when you're working for a particular company, this company will negotiate on behalf of all of its employees with the insurer. This typically happens via the broker network or with the insurance company directly. And because it is negotiating on behalf of a large number of people together, it will typically get better rates, right? So again, your group insurance is very, very aggressively priced. And anytime you have the person coming for the insurance having a good amount of leverage, your combined ratios will take a hit, right? So again, group insurance is moderately attractive. Within group, there are certain segments which are better, more attractive, right? So basically, if you look at your SMEs or your MSMEs, these are basically businesses where you have a smaller number of employees that you are catering to. And plus, in most of these cases, you'll typically only provide insurance to the employee, right? So a larger company, so suppose you're working for, say, a Godrej or a Mahindra or a Tata, they will not only give you insurance, in all likelihood, if you are an employee, they'll give your parents insurance as well, right? And this creates a challenge because while it is good for the employee, it is the likelihood of a older person kind of using that insurance tends to go up. So your claims frequency goes up, right? SMEs typically only insure their employees, and because they have a smaller group of employees and a smaller scale, the negotiating power there is lesser, right? So group insurance as a whole is not too attractive, but within group, say your SME or your MSME insurance is relatively a more attractive segment, right? And finally, we have retail. Retail is the most attractive of the lot. you have effectively individuals dealing with companies one-on-one, primarily via, say, a larger aggregator or an individual insurance agent and stuff like that. So you have a good amount of leeway with pricing. They're also fairly, they want a good amount of coverage, they want a good amount of network hospitals, and in a lot of cases, they're willing to pay for that, right? So retail is the most attractive part of the broader market, favorably priced, and very, very commercially attractive, right? So we look at all of this with data as we go along, right? So this is again from the 2023 IRDA annual report. The 24 report is not out yet. It comes out with quite a lag. So it'll come out next Feb or so. But this is the latest number that we have. Obviously, you can assume, say, around 5-10% growth in each of these segments, but a good number to work with. So as you can understand, Government of India underwrites the most number of people, right? So around 30 crore people in India effectively have government insurance. Around 20 crores have group insurance, which is basically the commercial entity that they're working with, negotiating insurance for them. And less than 5.3 crores odd of people have individual retail insurance, right? So if you look at this in the Indian context, we've got around, say, 140 crore odd people in the country, 5.3 crore odd covered under your retail. So a sub 4% penetration, right? So still a long way to go. But if you look at the amount of premiums that you're collecting, individual retail health insurance, despite having just 5.3 crore lives covered, has a very major chunk. Group has a substantially higher number as well. And government business covers a lot of people, but the premium per person is extremely low, right? So we've looked at the premium per policy number. For the government insurance, it's sub 280. For group, it's say 2,300 or so. And for retail, it is 6,500, right? So just kind of going in, you know which segment is going to be attractive to you from a insurance perspective, right? So we look at each of these segments one by one. The first is the government, as we've seen, covers the most number of people, covers close to 30 crore lives in the country, but has a very low premium, right? The premium is sub 300 or so. As you can understand, the intent behind this is not profits, but social welfare, right? So not being critical about this in any way, just that from an investment perspective, it might not be very lucrative for us to focus on businesses or doing this business, right? So again, this is underwritten primarily by public insurers who cover around 68% of it, and private insurers who cover 32% of it. Standalone health insurers have no presence in this system, in this customer group. And the business is also relatively slow growing at around, say, 4 to 7% or so, right? So good from a social welfare point of view, not too attractive for us from a commercial point of view, right? As you can see, the claims ratios of the business have been consistently north of 90% or so, in some years north of 100. These 2 years are kind of anomalies, FY 21-22, but throughout it's been not a very attractive business per se. As a result of which, the core segment that we're focusing on, which is the standalone health insurers, do not have a presence of that. And that is something that we actually like. This is a good segment from a social point of view, not a segment that we want exposure to, right? Coming to the second segment, which is group health. Group health, as you can understand, because it is done under a larger ambit, company kind of negotiating directly, primarily done via larger brokers. So these are commercial brokers who do large size deals. They'll get a lower percentage commission, but because the size of the deal is large, they end up making a good amount of money, or directly via the company itself, right? So primarily via brokers and direct sales. Again, because you have an entity which has a good amount of negotiating leverage, the pricing for the group segment is always under pressure. as a result of which your ability to make good underwriting profits in this segment will always be challenged, right? As we had discussed before, there are sub-segments of this insurance. So there are players, say, in the SME, MSME side, who have substantially lower leverage, which can make for kind of attractive underwriting. When we're looking at Star, we look at that transition as well, but just kind of important to know as such, right? Again, as you can see, and as is kind of understood, claims ratios for the group side will be substantially higher. Expense ratios will be lower. Expense ratios are lower primarily on account of commissions, right? Because as you could see here, a bulk of them are broker and direct. Direct, you'll have no commissions. Broker, you'll have very, very negligible commissions. So the commission structure is lower, which kind of reduces your expense ratio, right? So expense ratio will be lower, but your combined ratio still is closer to, say, 110% or so. So you're not making an underwriting profit on the larger group insurance segment as a whole. There are parts of the group health insurance segment which could make a profit, right? We'll cover that later, right? And again, renewal rates, because these companies have a lot of negotiating leverage, renewal rates tend to be lower as well, around, say, 70-75% or so, versus retail health, where the renewal rates are substantially higher, right? Closer to say 85% for a broader group. And as we will see, for well-run insurance companies, the retention rate, the renewal rate tends to be north of 90% as well, right? So group, again, better than, substantially better than government insurance, but again, not a very, very attractive business, especially the larger group insurance part of the market is not extremely commercially attractive, right? So important to know, and will be a core part of our thesis as we proceed through the exercise. Again, this is a segment where standalone insurers have a lower part of the total underwriting. So 46% of this is done by public insurers, 39% by private insurers, and just around 16% by standalone insurers, right? So the two groups that we've seen till now, government standalone had 0, group standalone had 16. A bulk of this 16 again will be focused on SME, MSME that we cover later, right? So as we've seen, standalone health insurers till now have had a lower weight on the segments, which brings us to the most important part of the thesis, right? This is retail health insurance. By far the most attractive, commercially the most attractive part of the insurance segment. Retail here kind of is miles ahead of competition, right? So retail has close to, say, a 56% share of market. Private will have 23%, public has just around 21%, right? Again, by number of lives covered, this is a relatively small market, around 5.2, 5.3 crores odd. I think we have numbers here. 5.3 crore odd lives covered. So a relatively small market by the number of lives covered, but gets in a very, very large percentage of the total premium income, around 35,000 crores of premium income, driven by the high value of the per insurance premium policy, right? And as we've seen, retail has a very, very dominant share here. It is important to note not only why retail has a dominant share, why standalone health insurers have a dominant share, but why they've been kind of able to maintain this, that we'll be covering when we look at the competitive landscape, right? What we're trying to establish here is primarily the attractiveness of the retail health insurance segment as such, right? As you can see, barring the spike during COVID, where they took a hit and the claims ratio was almost close to, say, 96% or so, retail health insurance typically will have a claims ratio of close to 70% or so, as we've discussed, if you have a claims ratio of 70%, a well-run insurer in the country can maintain a expense ratio of around 30% or so, which brings your combined ratio at close to 100%, lesser than 100% in most cases, and you run an underwriting profit, right? On your core underwriting business, you're running a profit. You also have your float income. On the float income, you'll make a good set of returns there as well, investing in fixed income instruments, which kind of generates a net profit for the entire business, right? So again, very, very attractive business. And again, important thing to note here is that this 71, 72% is for the industry, right? Well-run health insurers in the country, the standalone health insurers do substantially below this, right? So I think Niva Bupa will be sub 65%. Star Health Insurance again will be sub 65% claims ratio for a bulk of their history. Obviously, during COVID, they took a hit. But in most normal years, a good, well-run health insurer runs a claims of below 65%, focusing on the retail segment. Expense ratio of another 30% on top of that. Let's keep a combined ratio of 95% or so, right? So that is the holy grail for us. We want claims of below 65. We want an expense of below 30. Combined that will drive below a combined below 95, giving you a good underwriting profit in the business, right? As we've discussed as well, we've looked at retention as well, right? So retention numbers for retail are higher as well. 85% odd for the industry. For well-run players, it is north of 90, right? So a commercially attractive segment, a profitable segment, a high retention segment, right? And again, catered to by largely individual investors, because as we've discussed, a retail person, when he's taking an insurance, there is no go-to guy for him, right? So if you have a group insurance, your company is there to kind of stand by you as such. When you're taking an individual health insurance, most people tend to do it via an individual agent. And what that does is, when you have your claims process and stuff like that, your agent can effectively guide you through the process, right? Which is very, very critical for most people. This sort of granular way of reaching the customer has an impact on the business, right? As we've seen, the expense ratio tends to be higher because the commissions you need to pay out individual agents will be higher, right? These are people who are doing a small set of insurers for individual retail clients. So the percentage commission you will need to pay out is higher. But what it drives is a very, very granular business and allows you to have a moat by building a good individual agent network that we'll be kind of covering later, right? This is also the fastest growing piece of the overall puzzle, growing at, say, around north of 18% or so, growing substantially faster than the rest, and poised to kind of grow substantially faster as more people kind of move towards retail health as such, right? So again, just to kind of reiterate, retail is by a margin the most profitable part of the segment, the most sticky part of the business because you have very, very high retention, an extremely granular business because you have effectively individual agents reaching out to people and onboarding them, and a high growth part of the business, right? So by all means, the most attractive part of the business, and you want to effectively be focused on this segment as such. We've got a few questions in the chat, so I'll just try to answer those before we move ahead, right? I think Ankit Bhai had raised his hand as well.
No, Ganesh, I was talking about the question only, specifically one question by Anant, because he referred to the previous slide. So maybe you can take that question with the help of that slide.
Perfect. I'll just go through the questions one by one and I'll answer all.
That works.
So we've got one question by Surya. What is the backward integrated into health insurance? Right. So we look at, so I'll look at the first question. The first question is, what if large network hospitals kind of backward integrate into insurance, right? We've had one example already, which is Narayana. Narayana recently came out with insurance policy where they are effectively insuring a family of 4 for just 10,000 a year. And optically, they are giving you an insurance of up to 1 crore, right? This has a lot of ifs and buts, which are yet to know. So I think uh, the headline of it looks quite attractive. But if you look at the nitty-gritties, one, they have a cap on the age of the individual. So you have the oldest member in the family needs to be sub 45 or so. And you have also a restriction on the number of the place where you can get the insurance. Right? So Narayana, I think, has at least starting off a restriction that you can only take the insurance in the Narayana hospital. I think the intent there behind Narayana is substantially different. The intent there is primarily to reach out to the catchment around them and make sure that people from that catchment always come to Narayana. For Narayana, the average cost per admit is, say, 1,20,000 odd or so. It's a 20% margin business. So the average cost for them is less than 1 lakh per admit. The percentage of admits that you will have will be substantially lower. So it will still be a profitable business in my understanding. The way they are currently running it, in which you can only take it at Narayana, it will be a standalone profitable business for them as well. I think the intent there is primarily to be focused on bottom of pyramid, middle, low income people and kind of get them into the ambit there. Doing it with a larger chain will be difficult because people typically want, say, your middle and upper middle income people will typically be relatively mobile and they will want a choice of the care that they want to go to. So suppose, say, my mother has a particular type of problem, I would want her to go to, say, the Dhirubhai Ambani hospital. If my dad has, say, another problem which, say, is better catered to in Apollo, I would want him to go there, right? So I think people on the middle and upper middle income side of things would want a certain amount of flexibility with their healthcare, effectively going to the best provider of care for that particular need, which makes it difficult to cater to the larger side of things, right? So I think what Narayana is doing is quite attractive for them commercially and quite good in terms of intent as well, but difficult to scale across the board for larger chains is what my view is. And even if it's done, it might not be too attractive because people might want to go to a particular hospital for specialization, right? How to think of underwriting profitability? For instance, a person pays 10,000 for 9 years without any claim, but in 10th year, it's a claim of 10 lakhs. The underwriting decision is right. So the underwriting decision will never be on a person-to-person basis because that again will have volatilities, right? When you're taking an underwriting decision, you will be underwriting a larger group and trying to price them effectively, right? So when you are trying to underwrite, you are saying, I will say underwrite 1 lakh people in the 25 to 35 age group in the Mumbai metropolitan area. I will collect, say, 10,000 as premium for them. And my understanding is out of these 10,000, the 10,000 that I'm collecting, the number of people who will need that insurance and the claims that will come for that on an aggregate level will be lower, right? So on an individual to individual basis, you will obviously have, say, loss at a later date or claim faster than normal. So you could have, say, a 25-year-old who might suddenly have a very serious disease and a sizable claim from them. When you're underwriting for a broader segment, right? So you'll say for a particular age group, for a particular demographic, for a particular health sort of risk, that is how you'll try to underwrite it, right? So individuals will obviously vary, and that is why they're coming to you for insurance. Your responsibilities for an aggregate group have a good gauge of the kind of claims that they could have and price the product for them according to that, right? So according to age, as you age, your premium will increase. Depending on where you're staying, whether you're staying in a metro or a tier 2, tier 3, your premiums will differ. Depending on your pre-existing conditions, you could have certain restrictions. So pre-existing conditions typically most insurers will not cover for the first 3 years or so. The intent there is the claims that the premium that you're collecting in the first part of the phase kind of covers for that as and when it might come. So you will have various restrictions in the policy, but you're always looking at it at an aggregate level, right? Not on a individual to individual level. Okay. Underwriting profitability is at a policy block level, not an individual level, right? SMEs are typically done. So now we have a few companies who are doing it for SMEs directly, but SMEs are typically done via the broker network as well. So brokers will typically, so you've got large insurance brokers. The percentage cut they get is lower, but because they're kind of taking in larger clients, they get a good chunk of absolute money in. SMEs are typically catered to by them itself, right? It is not feasible for insurance companies to go the direct route here. So bulk of it will be done via insurance brokers, right? So insurance brokers again, so there's a difference in the size of client that you undertake and the percentage premium that you take, right? So an insurance broker will typically be focused on the group side of things. So say he will reach out to say HCL or TCS or one of these larger companies to insure the complete company as such. You will get a very small percentage cut of the total underwritten premium, but because it's a large client, the absolute money coming out to him will be higher. An individual agent will effectively be say people in your network, someone in your network will kind of reach out to you. He'll be managing say 20, 30, 50, 100 odd clients, a small number of individual clients. The commission he'll get will be higher, right? It'll be say 10%, 15% in that range. But because he's kind of underwriting smaller individuals who will have smaller absolute premiums, the commission that comes out to him will be lower, right? So that's the broader difference from a percentage and a absolute amount side of things. Is there any stock specific comparison in this presentation? Yeah, so when we are looking at Star, we'll be doing that well. So we'll be covering Star vis-a-vis other competitors as well as how Star is doing as well, which will give you a good understanding of the landscape, right? What happens in low interest rate scenarios? Right. So if you have a prolonged period of very, very low interest rates, it will obviously have an impact on companies. It will have a further impact on businesses who are not kind of running an underwriting profit, right? To give you a brief kind of bottom of paper calculation, bottom of envelope calculation on this. Suppose you are running a business which is say 65% claims, 30% expense. You're running a 5% underwriting profit or so. Suppose you're getting say 7% odd on the sorry. I'm sorry, was my screen disconnected for a while? Is it better? Okay, take. If you guys have any problems, it's working now, right?
Yeah.
Okay, perfect. Where was that? Yeah, low interest rates, right? So effectively, you have say around a 2.5, 2.4 to 2.5x leverage for a decent company. So say if you are earning say 7% on your book, 2.5x leverage will give you a say 17%, 18% pre-tax ROE. You will have another say 5-6% pre-tax ROE on your core underwriting business, which will give you 23-24% on pre-tax ROE, 17-18% post-tax ROE as such, right? In a country like India, this number will say not fall substantially below that. So it might go to say 6, it might go to 5 in a very, very dire situation, but you will have a good amount of leverage there as well, right? So even if you are say at 6 or 2.5x leverage, gives you 15% pre-tax on your underwriting, another 5-6 on your pre-tax on your investments, another 5-6 on your underwriting, which will give you a 21% odd ROE. Post-tax, that will still give you a 15-16% ROE as such, right? So in a country like India, for most rate environments, you are relatively well covered. So unless you have a very long period of substantially lower rates, that will typically not be a challenge. Right? Okay, I think just one sec. Ankit bhai, are you controlling the screen?
No, I don't think so.
Okay. ठीक है. Okay. Right. So unexpired risk reserve is basically in any particular period. I am not sure why the slides are moving.
Yeah, try resharing it. Maybe
Yeah,
this will work. Yeah.
is the slide visible?
Yeah, understanding the competitive landscape. That
Okay.
is.
Yeah. I think we had just one last question. Yeah. So unexpired risk reserve is basically so whenever you're taking any particular policy, right, there'll be a part of the policy which will flow over to the next year, which effectively you have to have a reserve for. The regulator mandates the underwriting risk reserve that you have. So there are three broad categorizations that the IRDA does for insurance. So you have fire, you have marine, and you have your other. So health effectively falls under miscellaneous. So for your fire and your miscellaneous, your unexpired risk reserve effectively has to be 50% of your net return premiums. For your marine, it has to be 100% of your net return premiums, right? So depending on the category that you're catering to, there is a regulatory mandate on the minimum that you have to kind of reserve for. Companies are also given the flexibility that depending on their own understanding of the risk, they can have a higher reserve than what is mandated by the regulator. But depending on the category that you're catering to, you will have to adhere to the minimum, right? So for a fire or a miscellaneous, which is health, you will have to have at least 50% of the net written premiums under your risk reserves as such. For your marine, it has to be 100%, right? You can exceed that, you cannot go below that as such, right? So just proceeding with the next slide for now. If you have any questions, please feel free to drop them in the chat, and I'll kind of take them as we kind of go through it. Right? Just one second. Sorry for the slightly longer session on a Friday evening. Just kind of wanted to be a bit comprehensive, covering everything. I'll try to go slightly faster as we go ahead, right? So just understanding the competitive landscape, again, there will be three major types of companies here. There'll be public companies like your National Insurance, your New India Insurance, Oriental, United. These companies, as we've seen in the first part of the earlier part of the deck, focused primarily on government underwriting. As a result of this, as you can see, their claims ratios will be extremely, extremely poor. In most cases, kind of running underwriting losses, right? So good to know about them, not very attractive for all intents and purposes. The second part of it, The second part of it is your private underwriters. These will be businesses doing multiple types of underwriting. So say your ICICI Lombard is one of the quality private underwriters, does motor insurance, motor own insurance, motor third party, does fire, does marine, does agri, and does health as well. These businesses will be focused on multiple types of health insurance, multiple types of insurance. Again, they're focused a bit more on the group side of things, a bit less on retail, as a result of which their claims ratios might not be very favorable, but still decent claims ratios, right? So substantially better than, say, your public. And the best part of the mix will be your standalone health insurers. As we've seen, these players kind of focus on the right segment, focus on retail, where they have a 56% odd market share, do good quality underwriting. And as a result of which, if you look at the claims ratios for these sorts of businesses, they're kind of extremely, extremely stellar, right? These numbers are from the Star RSP that came along, so a bit dated, but numbers have been broadly in the similar range going in the future as well, right? Bearing 21, 22, right? Now, we've understood that retail is attractive. We've understood that standalone is doing well because they have a good presence in retail. But it's also important for us to understand the sort of key moats that you have in the space, and why certain set of companies will always do better, or for long periods of time do better than the rest, right? The first is obviously individual agents. As we've seen, to reach out to the retail network, you need a large number of individual agents to kind of reach out to your customers. Here, as you can see, standalone health insurers have a substantially higher number of individual agents, and it's not higher by a percentage, it's higher by a factor, right? So it's 3x of private, 4x of public insurers. And despite being the highest in the base year, they're still growing the fastest, right? So they are onboarding a lot of individual agents and building the agent network faster, which will be a very, very critical mode to serve the retail client. Because as we've seen here, the channel of choice for the retail investor is the individual agent network, right? So 73%, so 3 out of every 4 broadly, retail customers buying it, buy it through an individual agent. And standalone health insurers are leagues ahead of competition when it comes to the individual agent network, right? The second is obviously when you are looking for an insurance company, you want the process to be as seamless as possible. For the process to be seamless, it is typically good to have a large network of network hospitals, right? So network hospitals will, as for you as a client, will give you an advantage of kind of seamless cashless insurance as such. So you effectively don't have to do much there. It'll also give you a good choice of, so a large network hospital list will give you a good number of options you want to go to, right? So suppose for a particular specialty, I want to go to Dhirubhai Ambani. For a particular specialty, I want to go to Apollo. I can kind of make that choice if all of them are in my network hospital list. Here, private insurers have kind of have a good moat here, but standalone health insurers are kind of growing well. And as we come to Star, we look at it. Star is kind of built a very sizable network of hospitals, which again stands as a good moat for the business, right? And the last is obviously when you are looking for an insurance, you want that when you need it the most, right? Because when you are actually in need of a health insurance product, you are actually the most vulnerable, and you want the claim settlement process to be as seamless as possible. Again, we've covered the average claim settlement days for standalone health insurer. It's 9 days. For private insurers, it's 13. For public, it's more than 30, right? So substantial difference in the claim settlement days for the companies as well. We look at the individual claim settlement ratios and the other metrics there when we're kind of deep diving into Star, but kind of good to have top of mind, right? And again, all of this is reflected in the numbers. claims ratios, as you can see, for your standalone health insurers are extremely attractive. Combined ratios, again, extremely attractive. For private and public, they are bad to say the least, right? Private at least are decent. Public, no sensible investor will kind of put money here, right? And the last part of it is effectively accounting standards. Accounting standards give us a small edge from the optical earnings point of view. So effectively, IRDA came out with their accounting standards in 2002, which are obviously, because it's a regulator, it wants to be more on the conservative side. So it came out with two sets of regulations: set of regulations A for your life insurers, regulation B for your general insurers, and the regulations are focused to be more on the conservative side. One major cost item for insurers is obviously the commissions that they're paying out. The regulatory guidance currently is to kind of expense all of it out in year one, irrespective of the duration of the policy, right? So even if you have a, say, 3-year health insurance policy, and you'll be kind of paying out the commissions accordingly, you're supposed to expense out the premiums in year one itself, which kind of brings down the earnings materially, right? So when we're looking at STAR, we look at this, but the typical impact on, say, players on the standalone side is between, say, 20 to 25% or so, a dent to earnings, right? Which when you look at, say, an earnings ratio, because the reported earnings will be lower, a person who is looking at the PE for, say, a standalone health insurer will see that the PE is, say, 40x or 41x or so. When if you look at the core IFRS earnings for the business, the PE then will actually be, say, 31, 32x or so, right? So, and this is something that is not only something that is the regulator's own intent to change, you also have visibility, right? So in all likelihood, by FY26, we'll be moving to IFRS. This will not only improve the kind of comparability of your performance versus global peers versus other peers. It will also, as we will demonstrate, kind of aid the earnings for these businesses materially. So you have a catalyst, you have visibility on the catalyst, and you know the impact of the catalyst on optical earnings, right? And as we will see here, the difference between your GAAP and your IFRS earnings is substantial, right? So because of the deferred expense, the procurement cost here is effectively the commissions that you're paying out. Because of that single line item, you have a close to 20% impact on profits, which kind of, so if a regular person just goes on screener and looks at the PE for these sorts of businesses, it'll typically be, say, 40x or so, wherein the core earnings for the business is substantially higher, right? So important for us to note that as well. So just summarizing, so the sectoral part of the analysis is broadly done. Just summarizing the key learnings that we've developed. One, we started off with understanding the India growth story, seeing why there is a need, as well as how it's reflecting in the growth that the insurance sector has been having. So very high need for insurance and a good long runway of steady high teens growth in the country. Second, we've seen how COVID-19 dented the business, and sentiments due to that could still remain slightly muted, which is an opportunity for kind of investors who are looking at the space more objectively. Third, we've seen retail health, the most profitable segment, the most sticky segment, the highest growth segment of the insurance market, effectively the only part of the market you want to be focused on. Next, we've seen standalone health insurers. We've seen their moats with respect to their individual agent network, their network hospital network, and their claims ratios in terms of how they kind of excel operationally, and their focus on the right segment has been able to help them kind of generate good, healthy profits as well. And lastly, we saw how the accounting changes to an IFRS standard could kind of improve earnings, at least as they are kind of optically perceived by the broader market, starting as early as FY26. right? With that done, let us now kind of move into Star Health Insurance, right? So, just give me one second, just have a sip of water and we'll continue. Sorry, the session took slightly long. I'll try to wrap the next half in another half an hour or so, so that we have time for Q&A as well, right? Again, before we start a stock specific disclaimer, I am personally invested in Star Health. All of my research clients are invested in Star Health as well. So please take everything that I discuss about the business with a grain of salt. Nothing that I'm discussing from this point onward is a recommendation. We're primarily trying to build a thesis and try to explain how to build a thesis around a retail health insurance company, right? So Star, as you can see, has a very, very strong history of consistent written premium growth, as we will see later. So it's the number 2 health insurer in the country. It is the number 1 standalone health insurer in the country, and by a margin. It's substantially ahead of its next of kin. In terms of operating performance, has been extremely stellar. So as you can see, bearing the 2 COVID years where everyone took a hit, it's been able to maintain claims ratios sub 65%, expense ratios broadly sub 30%, driving combined ratios sub 95%, right? And that's the holy grail. That's what we want when we are investing in this sort of a business. Loss ratios effectively or claims ratio. So claims ratio sub 65%, expense ratio sub 30%. Expense ratio here is slightly higher because as you can understand, they are focused more on the retail. Retail focus requires higher individual agents. Higher individual agents will require higher commission, right? So the core operating expenses are low, but because you are focused on the retail segment, your net expense ratio is slightly higher, but still extremely disciplined, right? So 30% expense ratio is an extremely disciplined number, driving the combined ratio of sub 95% or so. Again, very, very disciplined with the float as well. 70% of it is in AAA securities, governments, REITs, InvITs, stuff like that. Maintaining investment leverage at sub 2.5x, and even on 2.4, 2.5, as we've seen. So on a say 7% yield that you're getting in, say, last quarter, you had an abnormal yield. Through the cycle, assume say a 7.5% yield, or 2.5 on that gives you say 17-18% or pre-tax ROE just from your float, right? So extremely well run, not taking any unnecessary risks, at the same time earning a healthy return and ROE on the business, right? Very, very well moated business. As you can see, bulk of their underwriting is done via individual agents. We've seen broader retail underwriting around, I think, 72-73% done via individual. For Star Health, the number in FY24 is 82%. Even among standalone health insurers, stands out substantially in terms of the individual agent network. Despite having a very strong individual agent network to start with, it's been growing its agent network extremely fast. Currently has north of 7 lakh individual agents in its network, growing at say 15% or so. And if you look at the numbers across standalone health insurers, it is miles ahead of competition, right? So the next highest, which is Care, is at 280. Star Health is at 700. So Care is effectively 40% of Star, right? So 2.5x its nearest competition, growing at a very, very healthy rate, maintaining its strength in one of the key modes, which is the individual agent network as such, right? Bulk of its underwriting still coming via this channel. One challenge that was earlier present, and I think one of the earlier questions alluded to this as well, is the broader perception around Star was that they were lagging a bit on claims. What happens that now, because all of this information is very, very readily available, if a new client coming in sees that the claim settlement ratio is lower, the company might have a legitimate reason to not settle some claims because there might be some challenges in it. There might be fake claims, there might be spurious claims. But a retail investor, when he's looking at that number, if it's too low, it can be off-putting for the client. To its credit, Star has improved significantly on this. One, via better core underwriting. Secondly, also via moving out of relatively unattractive segments. So we'll look at that later as well. But broadly now, relatively competitive in terms of claim settlement ratios as well, at around 86.5%. Again, amongst retail health insurers, among standalone health insurers, the highest network hospital number, it is close to 14,000 plus network hospitals right now, growing significantly year on year. Network hospitals, again, as we stated, just reiterating, give you two major advantages. One, for the client, it is beneficial because there's a large number of hospitals you can go to and get kind of cashless, seamless treatment. For you as an insurer, whenever you're onboarding a network hospital, you will negotiate very hard on each of the processes and the surgeries, etc. available. As a result of which, the effective pricing to you will be substantially lower, right? So you're not only improving the experience from a customer point of view, you're also improving your reducing effectively the claims that you have in terms of the claims amount, thereby improving your core underwriting profitability, right? So having a good network hospital network and kind of consistently improving that is critical. Star Health, as you can see, is substantially ahead of competition here. What we also need to look at is we've established that it's a very, very strong operating business going in. What we also want to look at is there were a few areas of weakness for the business historically. How is the business now trying to kind of deal with those sorts of changes? The first, as you can see, group health is one segment which the business had a sizable exposure to, around 13% exposure starting in FY20. I think Mr. Junjunwala entered the business around 2019 or so. That combined with the management's own intent to kind of reduce exposure to group has now taken group as a total percentage of gross written premiums to sub 7% or so, right? So close to 7% from 13%. Reduces your exposure to a segment which is historically and even currently not very attractive, improves the quality of your total business, right? Even within group, as the management is kind of covered multiple times, the focus is more on the SME and the MSME book, where the clients are smaller, the negotiating power is lower, as a result of which the claims ratios are relatively in check as well, right? Unfortunately, we do not have a number to this in terms of what part of the group is SME, MSME. But the management intent is to focus more on the SME, MSME side of things, even on the 7% of group that is left, right? So group itself is, so it's a good growth segment. So you don't want to kind of be out of it completely. But what you want to do is selectively focus on more profitable parts of the group business and try to focus and grow more there, right? So doing the right things there. Within retail health, as we covered before, retail health is by far the most attractive part of the market. They've been able to maintain 33-34% market share consistently across the years in this segment, as we've covered, right? So health insurance by itself is a very, very sticky business. Once you've kind of got on a new client on board, if you do not do anything wrong, you'll typically have a good working relationship with the client and a retention of north of 90% or so, which helps you kind of retain and have a relatively sticky market share. But even the new customers that you are kind of acquiring, you need to capture a good part of the new customers as well to kind of maintain that share. And Star, to its credit, has been able to do that quite well, right? So we've already established that retail is by far the most attractive part of the market, and Star there has been maintaining a control of over almost a third of the market as such. Underwriting profits, again, we discussed this earlier when we were looking at the key ratios related to the insurance business. Again, as we discussed here, most health insurers in the country run an underwriting loss consistently. Star has been amongst the only players in the country who's been able to maintain a good, consistent underwriting profit. FY22 is obviously an anomaly, so you can ignore FY22 because this was the peak COVID impact year as such. FY23, FY24 are more years you want to kind of look at. Players across the board are all running underwriting losses. Star, Care, Niva Bupa are amongst better placed. Star in them stands out as the only one to generate underwriting profits in both 23 and 24, right? So important to note this as well. And again, so there were a few areas which were of concern to not only investors, but also clients, right? Because effectively, if you have a perception that the claim settlement ratio for a particular insurer is low, its ability to gain, so it will still retain share for a sizable period of time because the business tends to be naturally sticky, but its ability to gain incremental customers kind of goes down. And this was a concern in the broader investment community as well. But as you can see, the claim settlement ratio for Star has kind of improved significantly. And in all likelihood, as they've improved the kind of client onboarding processes, they should be able to maintain and potentially even improve their claim settlement from here. This is claims paid in less than 3 months. So this is again considered of the percentage of total claims which are actually settled. So claims which are not settled is excluded from this number as well. And as you can see, close to 99.2% and now close to 99.93%. So almost all of the claims that the company will effectively pay out are paid out in less than 3 months, right? Which is a good number to have. As we've seen, the actual settlement ratio is much lower, right? So the average claim settlement ratio for a standalone insurer is sub 9 days, will be similar for Star Health as well, right? What they've also done is, as you've increased the number of network hospitals, so in FY22, they had close to 12,500 odd network hospitals. That has moved up to around, say, 14,000 odd network hospitals now. What that does is, for the customer, as we discussed, improves the smoothness of the broader process. 95% of the classless processing that is done is now settled in less than 2 hours. What happens because of the increasing network, hospital network, is your the percentage of claims, cashless claims settled in your network hospital goes up. So that was 64% in FY22, has gone up to 74% in FY24. In all likelihood, as you increase the number of network hospitals that you have, this number will keep going up. As we've discussed in the past, this will have an impact on your claims ratio as well. Because you've negotiated terms with your network hospitals better, right? Claim settlement ratio, again, we've discussed how they've improved on that. Used to be closer to 80% odd a few years ago, improved substantially now to closer to 87%, and 99.93% claims settled in less than 3 months. 3 months again is a very long period. Bulk of the claims are settled in. As you can see, cashless claims, bulk of the claims are settled in less than 2 hours. Other claims are also settled in within a week, so right. So we've understood that the core business is very, very attractive, of working in an attractive segment, improve the core business significantly, which brings us to the last, or the second last part of the equation, which is looking at the valuations that you're entering in, right? So fair disclaimer, we entered at close to 500. The prices are now up 15-16% odd, so around 580 odd. So these numbers will all, so effectively take a 15% increment on all of these. So all of our, so on our entry, we were effectively entering a business where we had another 5 to 10 years of consistent high teens growth, strong underwriting profitability, the only health insurer in India to kind of generate consistent underwriting profits. Good discipline with your investment book, 7.5% investment yield, 2.5% odd 2.4% odd leverage gives you a 18%, 17% pre-tax ROE on investment. So well-run underwriting business, disciplined investment business, operating in a very, very attractive segment, well-moated, improving moats, everything going for it, priced at 27x trailing. So this is not even forward earnings, 27x FY24 earnings. It's run up, say 15-16% odd from now. So you can think of it as say 31x, 32x trailing now, right? Still quite attractive given the kind of growth and quality that we have in the business. If you look at larger private underwriters, so something like say an ICICI Lombard, obviously much larger group, much more well-known, well-understood, well-covered business. But as we look at the business here, so Star operates at, as you can see, a 96% odd combined ratio. ICICI Lombard operates at a 102, 103% combined ratio. Star has been growing faster than ICICI, has a better combined ratio than ICICI, does effectively everything else better than its counterpart. Price substantially lower. So ICICI is not a like-for-like peer per se, because it does a lot of other insurers, but just a comparable there, right? ICICI today, Lombard today is priced at north of 45x trailing. This is priced at sub 30, 31x trailing, right? So sizable difference in terms of the comparables, even though by all means you might have a better business, right? So difficult for a regular investor to say. In terms of other health insurers, we will have Niva Bupa. They've come out with their RHP now. They will list in all likelihood within a year or so. So I think once that comes out, there'll be a bit more focus on Star and the broader standalone health insurer pack as well. Care is effectively under the Religare group. Lot of nonsense going there, so we typically don't want exposure there. So they effectively having a takeover attempt by the Berman Group and the promoters there, effectively giving themselves shares to stop that sort of a thing happening. So a lot of special situation stuff happening there. Typically, I don't want to operate in those sorts of businesses. So Star is focused on a good standalone health insurance part of the segment, available at a very, very attractive valuation by all means, and having a good runway for growth, right? So for us, this is a core long-term holding for us, a business that we want to hold for the next 5 to 10 years, depending on how the business performs, right? So as we've covered, good business focused on the right segment, consistently improving the business and the areas it's focused on, available at 27x. So 27x then, 31x trailing now, still quite attractive by all measure. ICICI Lombard again. So this is again not like for like, because ICICI Lombard Health is a very small part for them, but you need some comparable. So by all measure, you have a better combined ratio, so you have better underwriting quality, you have a better growth, you have a more attractive entry valuation. And since IPO as well, so IPO you could say would have been at a higher price, but even since the IPO, it's taken a beating, went all the way down till 500. It's recovered slightly now, but still available at quite a attractive valuation based on our understanding, right? Again, not a recommendation. Please do your own research, do your own diligence, and based on that, you can take the investment decision, right? And last, it's obviously whenever we are looking at any business, it's important to look at the risks as well. With Star, broader market perceives two major risks. One is a supply overhang. So the late Mr. Rakesh Jhunjhunwala owns 17% odd of the business via various family entities. The lock-in ended in 24. Effectively, they can now kind of exit, right? What we have observed is that Star Health is relatively well institutionally owned. And whenever there have been major supply events happening, other institutions have been more than willing to kind of come in and take share, take the stake from the players exiting. So we do not think supply overhang. So one, we do not know whether the family wants to exit or not. And second, we are saying that even if they want to exit, there's more than enough institutional interest to kind of come in and take that share. The second is a composite license. As we'll explain in the subsequent slides, the composite license, in our view, is an optionality, not a risk, right? So the late stage Rakesh Jhunjhunwala owns around 17% odd of the business. The lock-in ended this year. The broader fear, not across the spectrum, but some parts of the market, fear a supply overhang coming in. To the business's credit, it's been executing phenomenally well, available at a reasonable valuation. So our perception is that there shouldn't be an exit event, especially from investors known to have a long-term view on good, well-run companies. But we're seeing even if that does happen, right? So there was a 2100 crore block that happened in May of 24, promptly absorbed by HDFC, Lotus, ICICI Prudential. All of it was taken up by your institutional players. Institutional players now own north of, so excluding Mr. Jhunjhunwala, institutional players own north of 25% or so. I think that it's relatively well covered business available at a good enough price so that the supply overhang isn't a risk for the core business. The next major risk that the market is a bit fearful of is a composite license, which will effectively allow life insurers to enter and offer health insurance. As we've established, a good individual agent network and a good network hospital network is very, very critical. Both of these are things that a typical life insurer will lack, which will make it difficult for them to kind of come and onboard customers, right? So you could say at least the individual agent network is something that they might have, at least some good, well-run insurers. But the network hospital is something that they have no coverage in. So when they come in, they'll have to work on establishing that, which is an effort in itself. If they don't want to establish that, they'll have to go through TPAs and other intermediaries, which will add to their cost structure, right? So to assume that a life insurer will come in and be able to underwrite better than you and underwrite the top tier premium customers that you want is unlikely. In all possibility, these will be focused more on the government, the health side, the government and the group side of things. Again, not segments we are too excited about. Standalone health insurers, in all likelihood, should be able to maintain the kind of control that they have over the retail side of the segment. If anything, this is an optionality for you because most of your premium customers who are coming for a health insurance product might also want a life insurance product. So for you, it could be a potential optionality, but for your core business, this is not a material risk per se, right? So which brings us to the summary of everything that we've learned through the session, which is the runway for health insurance in India, sentiment slightly dented because of COVID, retail health being the most profitable, sticky and high growth part of the segment, standalone health insurers being best suited to kind of capture this market, accounting standards kind of deflating earnings, which make them look slightly optically expensive, Star Health being amongst the highest quality standalone health insurers, maintaining dominant share, maintaining a very, very high profitability, the only underwriter to have consistent underwriting profitability. Businesses improved significantly, reduced group mix, within group mix moved to better parts of the segment, improved claim settlements, which was a major concern for a lot of people, available at a reasonably attractive valuation, substantially cheaper to counterparts. And the key major risks that the market thinks of, in our view, are a bit overblown. In case there is a supply come in, there are, it's a very, very well-run business, available at an attractive price. You have institutions come in to kind of take in share. And composite license, we feel the risk is a bit overblown. The ability for life insurers to come in and take share from the premium retail side of things will be relatively limited to nil in our view, especially doing it in a way that the standalone guys have done it, right? So these are the key learnings from the presentation. This is also in a way our thesis, right? A very, very attractive sector, a very, very well-run, efficient business in that sector makes for a very, very attractive core business, core holding for us. That's the thesis with which we've entered the business, and that's the presentation that we had to make, right? Took a bit of time to do it, took us around 2 hours, but hopefully was a relatively productive session and helped you guys understand the sector as well. I'll just take the questions from the chat for now. Why is Berkshire not interested? I think Ankit Bhai has covered a few of them, so I'll cover the questions which are not covered. So, okay, I think Ankit Bhai has covered most of the questions that were there. Thanks a lot for everyone who stayed till the end of the session. I know it's a Friday, so sorry for keeping you up on a Friday evening, but hopefully the session added value to you.
Thank you. Thank you so much, Ganesh, for the hard work and the time you have put in for the presentation. I think one question from Avdut you can take up. He asked, just wanted to know when the company starts hitting critical mass on operational front, what are the criteria around that, making it difficult for competitors to crack that advantage? Can any global example help here to understand the scale up? I think it
Right.
is.
So, as we saw here, right? So, with a few of the modes that you need to reach the retail customer, once you have an insurance network and you have an agent network, and because you are the primary player in the market, the agents that are working through you will also earn a higher premium, right? Because it is that much more easier for them to sell that insurance to the next client and kind of improve their income, right? Because the individual agent at the end of the day wants to optimize for his income as well. And if he has a product which is the market leader in that particular segment, becomes that much easier for him to kind of sell that particular product as well. Right. So I think we've covered a slide on the individual agent network, where as you can see, Star currently has 7 lakh individual agents in its coverage. The next competitor in the standalone space is Care, which is at 2,80,000, right? So 40% of the market leader in a way. And so you have a large chunk of people who can then now reach out to customers well. And because they are effectively selling a market leading product, the sale for them becomes that much more easier. The turn for them, so if you think of it in terms of the turns the agents are getting, that becomes that much more easier. And all of this will kind of have a positive flywheel, right? So you'll also have, say, the network hospital coverage. Network hospitals, as we've seen, the difference is not substantial, but still a sizable difference, right? So Star is at 14,000. The next peer is at around 10,000 odd. As you kind of keep increasing the network coverage that you have, your customers keep getting a better and better experience. And for hospitals as well, it's kind of better to, so they have to in a way liaise with you because a good chunk of the market, right? You've got 33% of the market. So if you are a large hospital chain in any of the metros or even a tier 1, tier 2 city, you want to liaise with a health insurer who owns 33% of the market, right? So health insurers will also liaise with you better. They'll give you slightly better terms, which then creates that flywheel, right? Because the hospital will give you a better term, the network hospital will give you a better term. You can then pass on that in terms of better pricing to the client and still maintain a very high claims ratio, a very low claims ratio, right? So you can maintain better underwriting discipline because out of sheer scale, you keep getting better terms in terms of all of the counterparties that you deal with, right? So those are the sort of flywheel effects that kind of kick in. And to start, they've also kind of started to kick into an extent. But as we kind of increase market share and grow further from here, in all likelihood, that should grow further.
Yeah. So Ganesh, a couple of questions from Anant at the end. Are
Right.
the agents exclusive to a single insurer? Can they not sell competitors' policy? That is one. And the second is the investment income marked to market, which can add volatility to earnings?
Right. So the regulator has a cap on the type of agent that you can work with. So each individual agent can sell products of one private insurer, one standalone health insurer, and one public insurer. So in each category, so the regulators effectively categorize people, and in each category, you can only sell one. So if you're selling standalone health insurers, you can only sell one of the 5 or 6 standalone health insurers. Similarly, for private, you can only select one of the 5 or 6 available. So within category, you have to sell only one, but there is no constraint of selling multiple. So you could be selling, say, a Star Health as well as a public or a larger private insurer product. But within standalone, you cannot sell 2 or 3 of the same insurer, right? So that is the only constraint in terms of selling multiple policies. So typically, once you have a lock-in there, within your segment, you'll not kind of move much. And as you can see, for retail, the individual are most important. So if you are locked in with Star for individual health, that is the go-to that you'll be selling as such, right? Investment income are mark to market, so that will have an impact, but that is typically very well managed and reasonably well understood by the market as well. So not much of a risk, right? So could create potential volatility if you have a very, say, sharp spike in yields in any particular year or so, but through the cycle kind of balances out, so not a major dent as such. The bear case is typically that, right? So the bear case is one is the composite license risk for a long time was an issue for people. Also, we need to remember that shortly after the IPO, the earnings, the financial performance that the business went through was not ideal, right? Because you're effectively in the thick of COVID. So for 2 years, you had combined ratios closer to 100%, north of 100% in some cases, which puts people at a bit of unease, right? That in our view has subsided. The core business is still very, very attractive. I think in some parts of the market, there is still concern over market share loss because of the claim settlement ratio that we discussed, right? Because there is a view in the market that because the claim settlement was, say, closer to 80% odd or so, it could dent incremental market share gains going forward. But as we've seen over the last 3 years, they've been able to maintain it really steady. The claim settlement ratio is now at a much healthier number. So when you're getting incremental customers in the door, that shouldn't be much of a concern, right? So plus you also have the supply risk that could come in. But as we've clarified, you had a large chunk of supply come in, 2,200 crores odd on a 34,000 crore market cap business is a large chunk, absorbed relatively well, right? So we don't think that is a major risk as well. So there are obviously market concerns, but I think the data shows that there is enough to refute the market concerns. And in all likelihood, you have a very bright future ahead for the business.
Thank you, Ganesh. So most of my questions were answered by your presentation and the questions which have been asked by the participants. One last question from my side. If you look at companies like Ditto and Digit, do you see that as a risk going forward for something like a Star Health?
Oh, sorry, which company?
I'm talking about Ditto and Digit. So
Okay.
basically, these companies take away the middlemen or the broker or the agents, and
Right,
Star
right.
Health is very much dependent on the agent model.
Right. While we were doing our diligence, we kind of checked with the kind of policies that folks like Ditto recommend as well. And Ditto, I think, recommends HDFC Ergo and one of the others, right? So most of their recommendations are focused on these two. And I think their intent is primarily from a claim settlement number. So HDFC Ergo has a relatively high claim settlement. So their focus is typically on that part of the segment. I think one, as you improve operationally, right? So I think Star, to its credit, has been focusing on improving claims. And once you start kind of improving that, there is no reason for even a player like Ditto to not recommend Star, right? So my understanding of it is primarily, the primary reason for that is they want their customers to have as seamless a claims process as possible. And that is why they tend towards, say, an HDFC or Go or stuff like that, who have a very, very stellar claim settlement number. I think as Star improves that, they should be amongst the top 2-3 that even the likes of Ditto, etc., recommend. And second, I think in terms of broader scale, they've been executing phenomenally well, but in the larger scheme of things for a country like India, they're still a very, very negligible player. Bulk of the underwriting is still via smaller individual agents. And this trend is not coming down. So you don't have a reduction in the number of agents, that's actually going up. So in FY18, I think we're closer to 72% or 65% or so. That number has actually gone up in terms of individual agents selling retail health. So I think while these players are doing substantially well, for a larger country like India, they're not too material as such. And because Star is a very, very dominant player, I don't think it will be a very major needle mover. So one is obviously it's not in terms of materiality. I think materiality is fairly low. And second, I feel as Star improves, no reason for these guys to not kind of include Star in the 2 to 3 insurers that they pitch as well.
Thank you so much, Ganesh. That was very, very, very helpful. And thank you so much for taking time out and putting up such a wonderful presentation. And as always, we'll put up the recording very soon and share it with our members. And Ganesh, I'll inform you also about the recording as soon as possible.
Thanks a lot.
Thank you so much, everyone, for your time and asking some really good questions. And thank you once again, Ganesh.
Thank you. Thanks a lot.
Okay.
If you like this session, then you will love our Mission Smile platform, जहाँ पे हम ऐसे ही टाइप के काफी सेशन हमारी जो टीम है स्मार्ट सिंह की वो ऑन अ मंथली बेसिस कंडक्ट करती है फॉर आवर कम्युनिटी मेंबर्स. Link in the description box below. Thank you so much for watching this session. Goodbye.